Do you need technical analysis? Do you need indicators to trade the markets? That's one of the most popular questions that I receive all the time. And the answer is no, you don't. Now, try to think for the past 2,000 years. For example, the commodities market, for example, is the oldest market in the world. Now, the number one thing, or the key things that individuals who are trading, for example, sugar, wheat, corn, barley, you name it, whatever it is. The main things that they looked at was what was the open price, what is the price of the day, what is the low, what is the high, and where the market closed on that day. That's all it is. That's all there was, right? So when we look at the markets, what we're looking at primarily is price action. What is price doing for that day, for that week, for that month, for the year, for a few years prior? What is the price action? And everything revolves around the high, the low, the close, and the time period. That's it. So fast forward in modern days time, for example, what we see is that we're so blessed to have so many tools at our disposal as traders. And everything revolves around price. So for example, if you trade the MACD or the stochastics or the RSI or the CCI, these tools, for example, will give you an indication of where price may be for that time period, right? So we use these things as a guide to dictate how we will execute our trading strategy, or how to close our trades, or just to get an idea of how the markets are trading for that particular time period. But nothing else replaces price action, guys. And so in this video, we're going to discuss how we use price action versus the position of the markets. Now, if you watch my other videos, you'll see one thing that's consistent, and that is I always talk about the 8-period EMA, the 20-period moving average, the 200-period moving average, also the CCI. Now, these things are not just indicators, right? It gives me the position of the market at a particular time, and how is price action relative to those moving averages and the CCI. So yes, you do not need any indicators to trade, because traders have been doing this for the past 2,000 years without indicators, and the only thing they focus on is price action, and price action. Let's go to the charts. Okay, traders, as promised, we're on the S&P 500, the E-mini, and we're on the 5-minute chart. And this is brought to you by TradingView. So we're on the free version of TradingView chart. Okay, so as promised, we're going to discuss a little bit about candlesticks analysis. As the title stated, we're going to discuss trading without the indicators. So the question is, can you trade without indicators on the chart? And the truth is that, yes, absolutely you can. Anything else are just guides that will help us become a little bit more proficient in our trading. So, for example, on the 5 minute chart of the S&P 500, each bar equals 5 minutes, right? So, as we can see at the bottom of the chart in this area, we can see how there was a bottoming pattern, somewhat, where there was a big push by the bears all the way down, and then the bulls tried to take charge, and eventually, what happened in this area, as we can see, let me just get my paintbrush up for you guys. All right, so as we can see in this area, we can see how the bears, they try to push it further. However, the bullish sentiment came in this area, and eventually we had an elephant bar that overtook the red bar in this area. So we had a strong push. However, the bulls in the first try, they were not successful, right? So what happens next? We have another strong rally to the upside, and sure enough, guys, what happens? We overtook in this area. So as we can see, this particular candle overtook the red and also the prior green bar. So this gives you a strong signal where you would enter in this zone, particularly, right? And then you can put your stop loss right below the structure in this area. So you would have entered here, and then stop loss goes right here, and then you would have another third push to the upside, and then the bears will try to check you just one more time. So what happens is that the bears stepped in, and they gave it one more try, and again they failed in this area. And then we have a doji, and then another push past the red bar on the second try on the bullish candle. So we had another elephant bar that overtook all the gains that the bears did in this area. And of course, what you would have done is added to your position in this area. All right. And then you would continue up, and every time the candle closes, you would raise your stop loss right below that candle, and then you would continue that, until the market was exhausted. So as we can see, guys, it's a strong bullish sentiment. And oh, by the way, this is an active chart. Okay, so as we can see, the S&P is still rallying right now. We're in the 6676s, which is I believe is a record today. So we can see how effective this particular strategy is, right? However, we need other confirmations as well. So the wonderful thing with the 20-period moving average, guys, is that it gives us a market position, right? It tells me where is candlesticks analysis relative to the 20-period moving average. And the 20-period moving average, guys, is one of the most effective moving averages throughout the industry, with from the big banks all the way down to the individual traders. I want to say retail, and also for those who are professional as well. So the 20-period moving average is very, very, very effective. So it gives me a position of where the candlesticks are. All right. So if I were to go back to where we first started, right, in this zone, right, without the 20-period moving average, we would still see price action. But what we wouldn't see without the 20-period moving average is what is price action relative to my position in the market. What is a position, right? So the 20-period moving average tells me that. So that information is so crucial when it comes to assessing candlesticks analysis. Secondly, the 8-period EMA, which is the exponential moving average, is the second tool that I use in my arsenal. Very effective, and all my trades are always including that as well. I'm trying to get my thing here to work. It's not working. Give me 1 second, guys. Let me try to see if I can troubleshoot this thing. For some reason or the other, I cannot open up my 8-period EMA. There we go. All right. Ah, technology, guys. All right. So where was I? All right. So the 8-period EMA. What is the 8-period EMA? Now it is the 8-period exponential moving average. So as far as reading price action, the 8-period EMA is very crucial in doing so. So it's all about what is the position of the candlesticks relative to the 8-period EMA. What is the position of the candlesticks relative to the 20-period moving average? So when I realize a position, I can go ahead and say, okay, the candlesticks are telling me that it is bullish or bearish. However, where is the position relative to those moving averages? All right, so as we can see, the candlesticks are very obedient to the 8-period EMA. So the 8-period EMA is like a moving average, except it is an exponential moving average. What does that mean? Well, it tells me the history of the low and the close of the past 8 candles, right? However, it also calculates and emphasizes the immediate reaction or direction of where it'll go most likely, right? So that's the thing with the 8-period EMA. It gives me that high probability of where price action will go, and it is very accurate, guys. Let me tell you, you're talking about 85% accuracy. So as you can see, how obedient price action is when it comes to the 8-period EMA. All right, so whenever we enter the markets and whenever we exit the markets, we use the 8-period EMA as a tool to do so. So, for example, if you had missed this particular pullback in this area, right? You missed the opportunity. What you would have done is just wait until there was a close above the 20 and a close above the 8-period EMA. So in this area is where you would enter to go long. Afterwards, as we can see, as price action progresses in our desired direction, we want to go ahead and move our stop loss right below this area. So as this candle closes, we want to add to our position, right? We could add in this zone or we can add in this area. And then we would put our stop loss below in this zone. And then we anticipate that the price will continue on because the candlesticks are closing above the 8-period EMA. That simple, guys. And then usually what happens is that we'll have a first push in this area, and then we'll have a pause, and then we'll have another push again. And usually I tend to want to stay in the market up until the third push. Now it can go to push 4, push 5. Sometimes when the market is extremely aggressive, you can also get a fifth push. But typically, I tend to want to exit the market when there's a significant rally on the third push in this area. So this is where I would have exited my position. All right, guys. So it's not rocket science. It's really easy. And as we can see, this market is very, very aggressive. This is Tuesday on the eve of when the U.S. government to decide whether they'll close or not. Hopefully, they'll stay open. I pray for everyone. I hope that the economy stays the way it is, or even improve. But I'm not a politician. I'm just on the side of mathematics. That's it, guys. I'm only a trader. What do I know? All right, but we will continue discussing the 8-period EMA and the 20-period moving average. And the answer again, guys, is yes, we can trade without indicators. However, it's good to have the tools that can help us improve our trading as we go along. All right, guys. So thanks for watching. We'll see you on the next one. Bye bye.